Now we'll come to a very important topic called international finance, or you can call it foreign exchange management, or in short we will call it Forex. So we will first today understand the basics of foreign exchange market. It is one of the most important topics of your syllabus and it is a very interesting topic. You will enter into a new world of foreign exchange management. Look at from the exam point of view, the weightage on this topic has been continuously increasing, and in some exams the weightage goes up to 20-25 marks also from this topic. This topic is very vast. So today we'll begin with the basic concept. As a chartered accountant also in future, you will be required to deal in foreign exchange. If you join some corporates, then you will have to handle corporate treasury where they have to manage their foreign exchange. If you join banks, okay, then also there is a huge dealing in foreign exchange. Or if you join some foreign exchange dealer companies, then also the knowledge of Forex will be required. In fact, in our day-to-day transactions also nowadays, the role of foreign exchange has gone up. If the dollar rate goes up, your mobile phone will become expensive, petrol will become expensive, this laptop which you are using can become expensive, right? So first I will start with very basic concepts of foreign exchange management, right? So start with the introduction paragraph. With the globalization of the world economy, there is a growing importance of international financial management. The world has become a global village. Now you cannot remain in isolation. You have to do transactions with the outside world. No country can be called as a self-sufficient. You are not a country where you can say we don't require other countries for import, export, borrowing, lending, services, etc. You depend on other countries for imports. You need to sell them to raise funds, to provide services, to receive services. So therefore, whenever the transactions takes place with other countries, there is a need to understand the international foreign exchange market also, because that can affect our profitability, that can affect our cash flows. Second is emergence of international capital and money market. Now you can borrow from abroad, you can invest abroad, you can borrow for long term, that is capital market, you can borrow or lend for short term, that is money market. The volume of international trade has gone up. Now India's volume of exports, imports have gone into many billion dollars, and therefore we have to manage this huge volume. With the globalization, liberalization, privatization, the borders are opening up. There is a free movement of man, material, money. So labor can move easily. You can find jobs in other countries now. You can invest in other countries. You can borrow from other countries. Restrictions are slowly getting lifted. But one of the major advantages of globalization is increase in the speed of communication and transportation also. Because of this, globalization is also happening very fast. Communication has become very fast now. You can communicate to anybody on earth now on your mobile phone, on your social media, WhatsApp, and there are so many other media. And that has made the world becoming more and more integrated now. The transportation has become very fast. Increased concern with respect to exchange rate and interest rate fluctuation. So one of the challenges that we are going to face now is continuous fluctuation of exchange rate and continuous fluctuation of interest rate. So as a business person, I need to understand what is happening in this global economy, and that might affect my business also. A change in exchange rate can affect my business also. Paragraph 2. Why international business? To keep you motivated, engaged, you also will be required to write something. So write down why international business. First reason I have written is exports. Exports. On the left side you write down exports. Under that write down 3 points. Exports opens up the global market. Exports opens up the global market. The whole world becomes your customer. Look at the products manufactured by companies like Apple, Microsoft, Sony, Coca-Cola. They are available in the entire world. In more than 200 countries, their products are sold. So imagine what kind of revenue they must be earning. Or if you look at the tech companies like Facebook, Google, Twitter, Instagram, entire world is using their services. So exports opens up the global market. When the global market opens up, it increases your sales. And when your sales will increase, profit will increase. So point number 2, write down there, increase in sales and profitability. The turnover of some global companies like Amazon or Apple, Walmart, they are into trillions of dollars now, more than what country can earn. So their sales is more than the GDP of some small countries also. Third point, why we need to export. Money is received in foreign currency. Money is received in foreign currency. So when you export, you can earn foreign currency, which is used to buy capital goods, like machines, equipments, components, investing in subsidiaries, joint ventures abroad. Use that funds to buy subsidiary, invest in joint venture, invest in associate companies abroad. So we need, India as a country need lot of foreign exchange to buy capital goods, components and to make investments outside India. One of the reasons for international businesses is imports also. No country is self-sufficient. They depend on other countries for their requirements. So imports bring cheaper and better quality products. Because of imports we are able to enjoy so many things, good quality and at low price. In the absence of imports, we could not have enjoyed a lot of things, and even if we could have, it would have been at a much higher prices. Like these mobile phones that you use, most of the mobile phones that you see around you, Samsung company, some Chinese companies or US companies. There are very few Indian companies you will find around you which are manufacturing mobile phones and you are using. See the laptop that you are using. It is Lenovo, Apple, Sony, and all these are foreign companies. Then India imports petrol and oil products, which is so much required for our economy. Second, read on purchase of capital goods. These factories require lot of machines, high-end machines which are imported. Raw material is required. Components are required, which are either not produced in sufficient quantity in India or which are not produced at all. So what we will do? We'll have to import. So raw material and components are imported. For pharmaceutical companies, they have to import a lot of raw material so that they can convert into the desired pharma products. Third point, write down right hand side box, global finance. International business is required. The main reason is, and it's very important for countries like India, you can raise funds from abroad. Money is raised abroad. Why can't you raise money in your own country? Because sometimes we require huge amount of money. And so much amount of money cannot be supplied by the domestic investor. But international investors have big pockets, deep pockets. and they can invest thousands of crores of rupees, and they are willing to take risk also. So all these unicorn companies in India, they are like Paytm, etc., PhonePe, they have got a lot of foreign funding, and that is why they are able to become such big companies. In the absence of foreign investors, they could not have raised such a large amount of money. So large amount of funds can be raised. They can borrow in terms of thousands and thousands of crores of rupees. And one more advantage of foreign currency funding is the funds are available at a very low cost. The interest rate may be just 2 or 3%, 4%, whereas if you borrow in India, the interest rate may be 14%, 12%. So imagine there is a gap of 10 to 12% rate of interest in local borrowing and international borrowing. So that is global finance. So slowly and slowly we are entering into this chapter, but first we'll just have some basic understanding of international business. What is the difference between international business and domestic business? When you are dealing with international customers or suppliers or clients, then you should be aware about the difference in the political system. Different countries may have different political system, different rules and regulation, different ideologies, different thinking towards the foreign investor, foreign companies, and they may affect your risk and return. So one has to understand that political system of different countries can be different. Like some example, India, democracy, people elect their representative, elections are held in free and fair manner. Anybody wants to contest the election can contest. Any people support, he comes to power, enjoys the democratic powers. But in some countries like China, one party system, that means not anybody can float any political party and start shouting against the government. You can't shout against the government. One government decides everything. Then our friendly neighborhood country, Pakistan, so they don't know what they are. They call democracy, but military has lot of interference in the political process. Some countries may have monarchy like Bhutan. So the king decides what has to be done. And then their ideologies may be also different. And that one should understand when you are dealing in international market. Second thing is the laws are different. Indian laws are only applicable to Indian territories, Indian citizens. Not every Indian law can be applied to foreigners. Indian laws may not be applicable to a foreign country. So therefore you should be aware about the rules and regulations of different countries when you are doing business abroad. The rules and regulations for the same transaction can be different. Taxation system can be different. If you don't know the taxation system of two countries, you can be into trouble. You may end up paying what is called double taxation. The country where you are doing business, they will also charge you the tax, and the countries where you are registered, incorporated, they may also charge you taxation. So that is why in your taxation syllabus you are taught about double taxation avoidance agreement. You are taught about transfer pricing. Okay, the purpose is that as a businessman I should know the implication of the transaction. This kind of things are not thought of also when you are dealing in domestic market. So when I am selling goods to Kerala, Tamil Nadu, Andhra Pradesh, Delhi, Do I think about double taxation avoidance agreement with these states? No. Do I think much about this transfer pricing, etc.? No. But whenever I deal with foreigners, I have to look at all these aspects. Cultural system is different. Different countries may have different cultural system. And as a businessman, we should know what is the culture of that country. Some countries are very aggressive in business dealing. Some are polite. Some are having lot of ego. So like that. Then if I am talking to another person in India, I will keep nodding my head, just indicating that I am listening to you. But if you nod your head in other country, they interpret you are agreeing to what they are saying. In India, nodding head means I am listening to you. In other countries, nodding head means you are agreeing to what he is saying, and therefore accordingly they will interpret the agreements. In India, when you go on the road, you just see another person, no smile, nothing. But in foreign countries, they may smile at each other, they may say good morning to each other. So these are cultural difference one should know. Otherwise, sometimes it may be difficult for you to do business. International business is more competitive than domestic business. International businesses are more efficient than domestic business. When you are dealing in international market, your competition is not only with your own countrymen, your competition is with the rest of the world. So an Indian company has to compete with a Chinese company, a Brazilian company, Thailand company, Filipino, and then he will be able to sell his product in the global market. So his product has to be of the highest quality in that category. It has to be at the lowest price in that category. Then the international trade is possible for you. Now we'll come to this chapter. When you are dealing with different countries, currencies are different, and that you have to be very much aware immediately when you are trying to deal in international trade. What is their currency? What is the exchange rate? What is the fluctuation in the exchange rate? Do you think about all these items when you are dealing in domestic market? No. When I am selling goods to a person in Kerala, do I ask him what is your currency? What is your exchange rate? How much it fluctuates on an average? No. But the moment I deal in international market, the currency comes into picture. Every country has its own currency, except in some cases where few countries have common currencies like in Europe. Then because different countries have different currencies, there is an exchange rate between every pair of currency. How many units of one currency is required for 1 unit of the other currency? And that is exchange rate, and exchange rate is fluctuating in most cases. Many countries have fluctuating exchange rate system, or what is called flexible exchange rate system, where the market forces are allowed to decide the exchange rate. Government does not interfere. There are few countries also where the exchange rate is kept fixed for some time, then the government may revise it later. For months together, the exchange rate may remain fixed in certain countries. But we in India have a flexible system. That is why you will see every day the rate of dollar changes. So this is about difference in international trade and domestic trade. Next question is, why do multinational companies operate in many countries? You will find Microsoft is there everywhere. Apple is there in all countries. Google has got offices in all the countries. Sony company has got their presence in more than 180 or 200 countries. Why? These multinational companies operate in many countries because number one, they want to reduce their risk. as we have discussed, there can be different types of risk, like political risk may be there, okay, exchange risk may be there. So this risk get minimized when you are operating in different countries. Operating in different countries are like holding multiple stocks in your portfolio. If one does not perform, the other may perform, and therefore your risk is diversified. So political risk there, exchange risk is there, interest rate risk may be there. So by investing in different countries, the risk is reduced, it gets diversified. But the most important reason is the second point, higher return. They are able to generate more and more profit when they operate in many countries. They are able to capture the market of different countries. Sales go up, profit go up, rate of return goes up. Many times these multinational companies operate in different countries to enjoy tax benefits also. So they will have production in one country, which gives them, they will set up production facility in one country, sales in another country, incorporation in some other country, and this way they are able to minimize their global tax liability. So they might incorporate themselves in some tax haven like Bermuda Island, Panama Island, okay. They'll set up production facility in those countries which don't have lot of GST or input taxation, and then they will book the sale through some country which have lower taxation here. This way they minimize their global tax liability. So these MNCs are looking for tax experts who can help them to organize their business, which will reduce their global tax liabilities. And point number 4 is they seek political stability also. First and fourth point are quite related. You can connect them because different countries have different political system. So if you invest in multiple countries, your political risk is diversified. Some country can suddenly ban a particular company, a particular country, that we will not allow companies from this country to operate in our jurisdiction. So that will create a loss for the MNC. So they invest in multiple countries. Even if one country stops them from doing business, at least they will continue to do business in other countries. So this was about why do multinational companies operate in many countries. Next question is, what are the basic problems in international financial management? International financial management has two basic problems. One is that foreign exchange rate is fluctuating. That is called foreign exchange rate fluctuation risk, or we will just call in this chapter exchange risk, because exchange rate will keep fluctuating. So how does it affect you? Let us look at the example of an exporter, and I will repeat the similar example so that you will understand. You are an exporter. See the risk involved. You have exported goods of $1 lakh. Today, which we will call in this chapter spot rate. The spot rate is 80 rupees per dollar. So what you thought? I will receive 80 lakh rupees, 1 lakh into 80. If I get 80 lakh rupees, I will make sufficient profit. I will earn my target profit margin. And accordingly, looking at the spot rate today 80 rupees, you quoted a price of $1 lakh. You thought I will get 80 lakh rupees, which will cover my cost of production and give me profit margin. But then the customer in USA said, we will pay you after 3 months. So US customer says, we will pay you after 3 months. So you thought, okay, no problem, he is a genuine customer. So we will assume there is no credit risk involved. After 3 months, he sends you a demand draft of $1 lakh, or he remits 1 lakh check to you. You go and deposit that check in the bank. Now the exchange rate after 3 months is 72 rupees per dollar. So bank will transfer or credit 72 lakh rupees into your account. Based on the spot rate after 3 months, the bank will transfer 72 lakh rupees into your account. And you are shocked. I was expecting 80 lakh. Now I got only 72 lakh. My cost of production itself is more than 72 lakh. So you will suffer this loss. If your cost of production was 75 lakh, in spite of selling goods of $1 lakh, you are incurring loss. That is called exchange fluctuation risk. Same problem can arise if you are an importer. So when you are importer, you imported goods of $1 lakh. The day you imported, the rate was say 72 rupees per dollar. Accordingly, you did your costing and you manufactured some product and sold in the market because you thought my cost is 72 lakh. But the payment was supposed to be made after 3 months. After 3 months, the rate has become 80 rupees per dollar. So when you go to the foreign exchange dealer to buy dollar, they ask you to pay rupees 80 lakh for $1 lakh. Oh, you are taken for a shock. You were expecting to pay 72 lakh, but due to exchange fluctuation, you will end up paying 80 lakh, 8 lakh more, and therefore you will suffer that loss. Same problem can arise to a borrower also. When you borrow, on that day the rate is 72. After a year, when you go to make the payment, the rate of exchange is 80. Not only you pay interest, but you also pay that exchange loss. Next challenge in international financial management is raising of international finance. Since liberalization, globalization, there are large number of avenues. You can raise funds from many sources now in the international market. Many countries allow you to raise funds from their country. You can raise funds in different forms. Like for example, you can issue ADR, GDR, FCCB, American Depository Receipt, Global Depository Receipt, Foreign Currency Convertible Bond, loan from foreign banks, etc. You have to compare the cost because different countries have different exchange rate, different interest rate system. You have to understand the terms and conditions of different countries. T&C, terms and conditions, because every country may put some different terms and conditions for raising of funds. So as a finance manager, I need to evaluate all the options available, understand the terms and conditions, rules and regulation, effective cost, and then I will decide where to raise the funds from. So in our syllabus, we have some chapters like International Working Capital Management, where we are going to learn how to take a decision as to where the fund should be raised from. So it not only depends on the rate of interest, it will also depends on other conditions, it will depend on exchange rates also, etc. Now we'll come to examination question. Please tick mark paragraph number 6. What are the various types of risk? Question in the exam is, what are the various types of risk in the international transaction? So international transactions means you are exposed to several risks. The main risk is foreign exchange rate risk, and our syllabus is based on this. Of course, we'll discuss some other types of risk also, but the focus would be on foreign exchange rate risk. These two examples we have already discussed. One was the example of an exporter. Exporter had exported goods of $1 lakh when rate was 80. When he received the payment, the rate became 72 rupees per dollar and he lost 8 lakh. When importer had imported goods, the rate was 72. When he was making the payment, the rate was 80. He also lost 8 lakh. So that is foreign exchange rate risk. Rate of exchange can either go up or come down, and it can result into loss for the company. If you are an Indian exporter and if the goods are exported to USA, if the dollar rate goes down, the rate per unit of dollar falls, exporter will actually lose. If you are an Indian importer and you imported goods from USA, and if the exchange rate goes up, you will actually lose. So therefore, sometime rate going up may result into loss. So for some entity, rate falling may result into loss. So that is called foreign exchange rate risk. It is a big risk for the borrowers and lenders also, because by the time they repay the loan, the exchange rate has gone up. So they end up paying more than what they had received at the time of borrowing. Foreign exchange rate risk will be divided into three types. So even you tick mark these three types, in the examination they have asked questions. What is a transaction exposure? What is a translation exposure? What is an economic exposure? Or they can ask you, distinguish between transaction exposure and translation exposure in the context of foreign exchange management. So we'll now take one by one these three types of risk. Transaction exposure. What does transaction exposure means? It means when you settle a transaction, exchange rate may change, and because of that, the rate at which you had entered into the transaction and the rate at which you settle the transaction, there will be difference, and that difference may result into loss. That is called transaction exposure. Okay. The monetary value is fixed in terms of foreign currency at the time of agreement, which is completed at a later date. So first I will give you an example for more clarity. Actually that example I have already given. Transaction exposure or transaction risk. In exam they can also call it transaction risk. Suppose you are an exporter. You have exported goods of $1 lakh. You have exported goods on 1st April. That day the rate was 80 rupees per dollar. I am repeating the example for understanding. On 30th June you received the payment. The importer in USA made a payment of $1 lakh. You go to the bank and you tell the bank that please convert into rupees. Bank will convert at 72. Transaction is complete. Transaction is settled. So what is your loss? In this example, the loss will be $1 lakh into 8, rupees 8 lakh. Now the transaction is settled. So this is a realized loss because the loss has been realized now. A transaction has been settled. Now loss has been realized. You have to book this loss, right? You have to take this hit. If you are an importer, you have imported goods on 1st April, $1 lakh. So that day the rate was 72 rupees per dollar. So you were happy that if I pay 72, I will sell the product in the market at some rate and I'll make profit. You are supposed to make payment on 30th June. On 30th June, when you go to the bank to make the payment, bank says today the exchange rate is 80 rupees per dollar. So you can buy $1 lakh at the rate of 80. So how much is the loss? Same 8 lakhs, but this time because of increase in the exchange rate. Importer suffers loss because of increase in exchange rate. Exporter suffered loss because of decrease in exchange rate. And the loss has been realized because the transaction has been settled. Transaction has been completed. So that is called transaction exposure. Now you'll understand transaction exposure means a transaction may be settled at a different rate than the rate at which it was entered into. And why it is a big risk? Because it's a realized loss. Now the loss has been booked. Nothing can be done about it. Next is below point B, translation exposure. So first I will explain you what is translation exposure. No need to write big paragraph, understand. You are also a student of financial reporting or accounts, whatever you call it. In financial reporting, there is one Ind AS 21, or if you have studied in accounts, there is a similar standard called AS 11. Now what these two standards is that on the reporting date, this is same in both the standard, on reporting date your monetary assets and liabilities, A and L, assets and liability should be valued at closing rate, and the difference will go to your P&L account. Difference will go to P&L account. In general, there may be few exception here and there. So monetary items means your debtor, creditor, bank loan, bills receivable, bills payable, cash and bank. Those are monetary items. Now this is a company. In the balance sheet of this company, they have huge debtors. But these debtors are foreign currency debtors, 1 lakh. When the goods were sold, that time the rate was say 75. So debtors were initially booked at 75 lakh because we are an Indian company. Our reporting currency, or what we call functional currency, in India is 75 lakh rupees. But then year ending date came, 31st March. We found that there is a debtor in our book, $1 lakh receivable. So the accounting standard or Ind AS 21 says you have to value the debtor at the closing rate. Closing rate means balance sheet date rate. So on balance sheet date, the rate is 70 now. So what I will have to do, I have to now show this debtor at 70 lakh. I have to translate this debtor at 70 lakh. And what about this difference of 5 lakh? It was appearing at 75 lakh. Now it will appear at 70 lakh. So this 5 lakh I will have to write off in P&L account. So there is a loss in P&L account. In my balance sheet, the value of the assets will fall. The value of the assets will fall. So if the value of the assets will fall, my net worth will also fall in the balance sheet. My net asset will fall. My value of business will fall. You have studied suppose business valuation chapter, asset minus liability, value of the assets will go down, means value of the company will go down. So that is called translation exposure. Change in the value of assets and liability in the balance sheet due to change in the exchange rate. And if suppose there is a loan, reverse can also happen. When you took the loan, the rate was 65 a year ago. So the loan is appearing at 65 crore rupees in your balance sheet. You have borrowed this loan on 1st April, beginning of the year. Then at the end of the year, you found that the exchange rate is 75 now. You have taken a loan of 1 crore dollar. The rules of accounting standard or Ind AS requires closing rate valuation. Closing rate is 75. Same loan will now appear at 75 crore in your balance sheet. So there is a loss of 10 crore. This 10 crore loss will be transferred to your P&L account, and the liability will go up, means net asset will go down, net worth will go down, the value of the company can fall. Then the question is, what is the difference between transaction and translation exposure? Translation exposure is just an accounting exposure. Accounting, it is arising due to rules of accounting. And second thing, it is an unrealized. It is an unrealized gain or loss because the transaction is still not settled. The debtor is still there in my books. The loan is still there in my books. Only when they will be settled, I will have real loss. Right now, it is only a book loss. Okay, paper loss. But it can turn out to be an actual loss when the transaction would be settled. So now if you read this paragraph, you will enjoy. This is a 4-mark theory question, translation exposure. This much you have to write. It refers to the probability that the firm may suffer a decrease in asset value due to devaluation of a foreign currency. I had given example of a debtor, even if no foreign exchange transaction has occurred during the year. It is also called underlying accounting exposure. Example, an asset like debtor loan given will lose value if the foreign currency rate declines. But in case of liability items like creditor and loan, the risk is that exchange rate may increase, the value of the liability will increase and you will suffer the loss. Now we'll directly come to point number C, economic exposure. So first I will explain this economic exposure. Economic exposure means risk of change in value of the firm or value of the project due to exchange fluctuation. So this is a one-liner, risk of change in value of the firm or the project due to exchange fluctuation. Now understand how this risk will arise. Very dangerous risk. It can reduce the value of the firm like anything. There is an Indian company, just understand, and this type of question will come in our questions later. Very important topic, concentrate, revise every day whatever is covered. Don't sleep till you revise. Indian company has a project or an investment in USA. So initial investment, they must have calculated initial investment, say 500 crores of rupees, because they will have to invest, first rupees will be converted into dollars. So 500 in Indian rupee converted into whatever dollar. Now you will estimate what will be my future cash flow from this project. This project has a life of 5 years. Project is in USA, so cash flow will originate in dollar first. Cash flow will come in dollar first. So you estimated that it will be $20, $50, $70, $80, $100, whatever. And then what you did, you converted into rupees. How do you convert into rupees? You will estimate the exchange rate. See, you are investing today in a project. Capital budgeting chapter you have learned. It will generate cash flow over 5 years. Cash flows you have to estimate. Exchange rate also you have to estimate, because exchange rate fluctuates. So you estimated certain exchange rates based on whatever knowledge you have, based on your understanding of foreign exchange market, based on quotations received from various dealers. You thought that these are the exchange rate which will be prevailing over next 5 years, and accordingly you calculated the cash flow in rupees. You calculated the present value of cash flows. So far you have understood. First you invested. Originally your cash flow is generated in dollar because it is in USA. You applied the estimated exchange rate, and here is the trouble. Convert into rupees. Present value suppose is 520 crore. Your NPV is 20 crore positive. You went ahead, you started the project. So what is the problem now? This exchange rate which you had assumed in the future year, actually when the project got started, the exchange rate actually turned in the opposite direction. You thought it will be 77, but it was 74. In second year you thought it will be 80, but it was 74. So that way you received much lower than what you were expecting. So project which seemed viable on the basis of assumption of certain exchange rates turned out to be a loss making project, because the exchange rate did not change as per your expectations. So this is called economic exposure. It refers to the probability that the change in foreign exchange rate will affect the value of the firm. You have studied valuation chapter. Valuation of a firm under DCF model is you estimate the free cash flow, which we did in our example, and you find out the present value. But because these free cash flows are linked to exchange rate in future, and if the exchange rate does not change as per your expectation, it moved against your expectation, this calculation will go down, present value will fall, and which will affect the value of the firm or the value of the project. More about this as we will proceed ahead in this chapter. Next is interest rate risk. So actually this is not related to this chapter, but the general question is, what is overall risk in international financial management or in international transaction? This risk will arise if you have borrowed or invested in other countries and the interest rate may change. Just like exchange rate is a fluctuating variable, interest rate is also a fluctuating variable, and it can affect your profit and loss. How? Suppose you have borrowed on floating rate. One full chapter you have studied interest rate risk management. Okay. And there we have seen, if you have borrowed on floating rate basis, suppose you have borrowed from UK on floating rate, LIBOR plus 3%, and then the LIBOR started going up. If the LIBOR starts rising, you will be required to pay more and more interest. So LIBOR was 2, so you were paying 5, but then the LIBOR in the next period became 3, so you will pay 6. LIBOR becomes 4, you will pay 7. but this is a very high cost for your company. So this will entail uncertainty as to future interest payment, as interest rate may change on each reset date. So if you are borrowed in floating rate, if the benchmark rate goes up, your cost of borrowing will go up, cost of borrowing remains uncertain. Then you will say we will borrow in fixed rate. Once you borrow in fixed rate, suppose you borrowed at 5% for 10 years, you have locked yourself for 10 years at 5%. Now it is possible that in the market the rate of interest has gone to 4%, 3.5%, 2%. Will you be able to enjoy this lower rate of interest? No, because you have exposed or you have taken a fixed rate of borrowing. You may think that I will repay this and I will issue fresh loan. It's not easy because there may be some prepayment charges. There may be some issue expenses. Next interest rate risk is reinvestment risk. Reinvestment risk means you may assume that once you receive the interest, it will be reinvested at a certain rate. So once you suppose you have invested in a bond which pays 8% coupon, you are assuming that once I receive 8% coupon, I will be able to reinvest it at 8%. After 1 year you received coupon of 8%, but the market rate has gone down. Now in the market the rate of interest is 6%, so this reinvestment assumption is not valid and you have to be happy with a lower rate of reinvestment interest. One of the challenges in international transaction is credit risk, because the supplier is in India and then this customer is in USA. Now imagine the risk, which you can easily imagine. If you are selling on credit basis to a US party, what if he does not pay? You will file a case against him in the Indian court, but the Indian court will not be able to catch hold of him. He is in USA. Then you will use diplomatic channels. You will go to Indian embassy. They will request the US embassy. US embassy will request their US government in USA that please ask this customer to make payment to this Indian supplier. Who is going to do all this? Unless you have a very high degree of political connections, you can't file a case in US court. You are not a US company. Maybe you will go for some international arbitration or international courts of justice, and you can imagine how much time consuming and how much costly that affair could be. So that is called credit risk. The counterparty does not perform. Simply put, the counterparty does not perform what he was supposed to perform. So it can be related to a sale or purchase transaction. It can be related to a derivative transaction. It can relate to any such transaction where the counterparty, who can be a bank or a customer, fails to meet his obligation. And sometimes open position has to be covered at the going rate of exchange. So you have entered into a forward purchase contract. Example of second line, $1 lakh in forward market you have purchased at 70 rupees. So you are thinking that after 6 months I will be able to buy $1 lakh at 70. On maturity, the counterparty said, no, sorry, I can't deliver you $1 lakh at 70. What you'll do? You need $1 lakh to make your payment. Your reputation is at stake. You will go to the market, buy dollar at 78 rupees. That is a loss. Counterparty did not perform. And in order to settle the transaction, you have to pay at market rate, which may result into loss. Next is legal risk. Legal risk arises from the legal enforceability of a contract. When you are entering into contracts with international supplier, customer or any such party, you should take the help of legal experts. Check whether the agreement has been properly drafted or not. Check whether whatever you have agreed is properly drafted in the agreement or not. Otherwise, you might have to suffer the loss, because some contracts may become legally enforceable against you. And if you are dealing with strong countries like USA, they may force you to follow the terms and condition of that contract, which may result into losses to you. So hence and therefore, we always take the help of legal experts when we are entering into some kind of contractual relationship with foreign parties. One more risk, liquidity risk, very dangerous risk. You may have an asset, but it cannot be converted into cash. You may have a bank account in USA, but what the American government can do, they can freeze your account. You can't withdraw money from there. You may have a foreign currency asset, bond or shares in some foreign country, bonds, but you can't sell it, and if you sell it, you will have to sell it at a very heavy discount. That is called liquidity risk. So many times when we are dealing in the international market, we have to be careful about this risk. After understanding the risk, then we should take the decision to do transaction with the foreign parties or not. So this question you tick mark, what are the risk involved in international transaction? What are the different types of foreign exchange risk? What is the difference between transaction risk and translation risk? Right. Now we'll come to some more basic discussion. You directly come to paragraph number 9. Paragraph number 9, where I am going to explain many things. What is written in paragraph 9? Key participants in Forex market. Write down to keep you engaged, motivated, awake. Who are the key participants in foreign exchange market? Who are the major players? First is, write down RBI, in bracket central bank. RBI or central bank. In India, RBI, in other countries, the respective central bank. Second, in India, the second major player is the banks, because banks are the authorized dealers. That is, they are given permission, or you can say license, by the RBI to deal in foreign exchange. So banks and authorized dealers. Those who are authorized by RBI to deal in foreign exchange, they can buy foreign exchange, they can sell foreign exchange. You can't go to anybody and buy and sell foreign exchange, that is illegal. You have to only go through authorized dealers. Then corporates. Corporates need foreign currency for exports, imports, borrowing, lending, services, starting some joint venture abroad, investing in subsidiary and associates abroad. So they would need foreign currency, and they go to banks or authorized dealer and they buy respective foreign currencies. In addition to corporate, there are other business undertakings also, like firm, who need foreign exchange for buying raw material, components, equipments, plant and machinery, traveling, etc. And then individuals like you, why do you need foreign exchange? If you are a student, you have to suppose go to Stanford University, Harvard University, Oxford University. You will require dollar, pound, or if you just want to travel for pleasure purpose, leisure trip, you will need foreign exchange. If you have to appear for CPA exam, Certified Public Accountant exam of USA, then you will have to make payment in US dollar. If you buy something from Amazon USA, you will have to make payment in dollar. So therefore, individuals are also requiring foreign exchange. I hope you have noted. Now next is major trading currencies. Which are the four strongest currencies? They are called strongest currencies because they are universally accepted. You can go to any country with dollar, you can give dollar to the exchange counter and they will give you whatever currency you require there. So dollar, pound, Japanese yen and euro, these are the four major trading currencies. Most of the international transactions happen in these four currencies, and more important is the US dollar. These currencies have certain symbols, as you are aware, like this US dollar symbol is this dollar symbol. This is the symbol for pound, this is yen, this is euro. And there is one more convention to write the name of the currency in usually three alphabets. Like United States dollar is written as USD, Great Britain pound is written as GBP, Japanese yen is written as JPY, euro is written as EUR. It is a currency of some countries in Europe. Britain is not a part of it, so Britain has its different currency pound, but many other countries like Germany, France, Italy, Netherlands, Austria and some more, Belgium, they use this euro currency, common currency in around 14 or 15 countries in Europe. And what about India? Is Indian currency is a major trading currency? No, it is traded within India only, and maybe in some neighborhood countries like Nepal, Bhutan, okay, and some such small countries which are our neighbor countries. So you can go to Bhutan with Indian rupees and you can spend directly Indian rupees, no need for conversion. Or you can go to Nepal and spend in Nepal Indian rupees, but many other countries you can't use Indian rupee. So before you land into that country, you need to first get your rupee converted into that country's currency. Most of the airports have these exchange counters, so where you can get your currency converted, and there are some exchange dealers also situated where you can get it converted. Now next paragraph number 11, administration of foreign exchange in India. How foreign exchange is administered in India? You are a student of final course, so you know that in India there is a law called Foreign Exchange Management Act, FEMA. In short, FEMA. Before FEMA it was known as FERA, Foreign Exchange Regulation Act. That for FERA was very stringent, very harsh, very strict, and the punishment was very strict also. In case if you violate that law, then maybe you will be imprisoned. For a small violation also you can be imprisoned under FERA. Then they made it FEMA because when before 1991 India had shortage of foreign exchange. They wanted to use it very efficiently, judiciously. But now India has got a huge foreign exchange reserve, which as per the recent estimate it is more than $400 billion. Now they don't know what to do with this such huge reserve. So the situation has changed. So they are allowing you to travel abroad, carry foreign exchange, enjoy. You can invest also abroad. You can buy properties abroad, shares abroad, subject to some restriction, but it is very free now. So that is why it is called FEMA. Of course, you have to follow that regulation also. You can't violate it. FEMA is managed or administered in India through central government and RBI. RBI will give license to authorized persons, and only the authorized persons can deal in foreign exchange. So, advice to you also that whenever you are acquiring foreign exchange from a party, that party should be an authorized person. You can't just go to any other person and say, take this rupees, give me dollar. That may be illegal. Authorized persons are of two types: authorized money changers and authorized dealers. Authorized money changer can also be full-fledged or restricted. Full-fledged means they can buy and sell foreign exchange. Restricted means they can only like buy. Hotels are usually restricted money changers. Some of the hotels, when a foreign tourist will land and that fellow has only dollar with him, where will he go in the morning? He has to attend some meeting in India, but he does not have rupees, so he can go to that hotel. The hotel will give this facility. They will take dollar from him, give him the local currency. Full-fledged means they can buy and sell. Nowadays, most of these tour and travel operators, if you want to go to some foreign country, this tour and travel operator will give you foreign currency first. When you return back with some change left with you, they can acquire it from you. All these foreign exchange dealers have an association that is called FEDI, Foreign Exchange Dealer Association of India. This FEDI is like you can say like an ICI or any organization which will provide rules and regulations for its member. They will give them code of ethics which the authorized dealer should follow. They will give them some instruction as to how much maximum margin they can have. So all these are governed by this FEDI. So we will come to this FEDI in some chapter later. Now next paragraph in your book is paragraph 12. What is paragraph 12? Determination of exchange rate. Determination of exchange rate. So first I will discuss that. How is exchange rate determined? Exchange rate is determined by demand and supply forces. If the government does not interfere. So you draw this diagram. Okay. You have studied economics in your 12th standard or maybe while doing foundation course or in your BCom, BCom. Demand and supply, and here is exchange rate. So first of all I should tell you what is exchange rate. Exchange rate means number of units of one currency required to be given for 1 unit of the other currency. Like in India we'll say 75 rupees per dollar. That is exchange rate. You need to give 75 rupees to obtain $1. So exchange rate is the price of foreign currency. I will put it like this: exchange rate is the price of foreign currency. Just like you pay price for, let us say, a notebook, 45 rupees per notebook. So now remove notebook, 45 rupees per dollar. So it becomes the price of a foreign currency. And how it is determined? By the demand and supply forces. These are the two lines, and I am going to ask you a question. That is why I have not written this diagram in the book, because I have to ask which line is the demand curve and which line is the supply curve. The downward sloping curve is the demand curve So that we'll call demand curve, demand for foreign exchange. And this upward sloping curve is called supply curve, which shows supply of foreign exchange. So how the exchange rate will be determined? Exchange rate will be determined where demand and supply curve will intersect each other. So this will be the exchange rate. Now you read that note. Rupee US dollar rates are determined by demand and supply factors. What about RBI? Does RBI interfere in the determination of exchange rate? RBI intervenes the market only to stabilize the exchange rate and prevent wide fluctuation. Sometimes it may happen that demand has suddenly gone up. The demand curve rises. A new demand curve comes. So what will happen now? The new exchange rate would be this much. Okay, don't mind this line. Assume it is a straight line. So this would be the new exchange rate. You can see the exchange rate has gone up so much because of too much of demand for foreign currency. So what RBI will do, in order to bring the exchange rate down, they will supply exchange rate in the market. They will supply dollar in the market because RBI has got dollar reserve. So now they will increase the supply. So a new supply curve will come. So you will find now the rate of exchange has gone down. So this I will call ER2. So first it was exchange rate, ER. Due to increase in demand it has gone up, but again due to increase in supply it has come down. So what happens in India, generally the market forces will be allowed to decide the demand and rate of exchange. But sometimes if the rate moves too high or it goes down too low, then only RBI will interfere. Either it will supply the dollar in the market or it may purchase the excess dollar from the market. If the rate goes too high, that is also not good because importers will suffer. If the rate falls, the exporter will suffer. So if the rate is suppose 75 and it goes to 85, importer will suffer. All the imports will become expensive. And India is a big importing country because lot of things are imported like oil, machines, equipments, electronic items, raw material. So those all will become expensive. And if suppose the rate goes down to 70, exporter will suffer because they will receive lower cash inflow in rupees on conversion, and then there is no motivation to export, and then they will not export goods. India will not earn foreign currency. So therefore the RBI will try that this rate of exchange does not become too volatile. So India has flexible exchange rate system, but sometime RBI can interfere. Now we'll see what do you mean by currency. Paragraph number 13. What is currency? Currency is the legal tender of any country within its national frontier. What do you mean by legal tender? Legal tender means you can use it for making payment. You can use it for making payment. So if you buy some goods, you can use the currency of that country in that national frontier to settle that payment, and the other party cannot refuse to accept it. So if you have this 100 rupees note and if you buy something of 100 rupees, you can use that 100 rupees note to make that payment, and the other party cannot refuse it. Refusing the national currency of a country in the national frontier is a crime. The person can go to jail who refuses. Of course, there are some minimum restrictions, like you can't give coins of 2 crore rupees if you have to make the payment. You have to make a payment of 2 crore and you took 1 rupee coin, 2 crore, and give it to the payment, then maybe in that cases some restrictions are there. When we buy or sell goods, we give or take currency in exchange. So currency has made our life very simple. You buy goods, you give currency. You sell goods, you receive currency. So because of currency, that barter system has gone away. Otherwise, earlier, when currency was not there, people used to barter. So one person will give rice, the other will give milk. Then only the transaction will happen. Because of currency, transactions have become smooth. Currency has made transaction feasible, possible. Come to paragraph 14. What is exchange rate? Exchange rate means the rate at which one currency is exchanged for the other. Example, suppose we have to give 76 rupees to get $1. The exchange rate is 76 rupees per dollar, and this is the exchange rate for dollar, exchange rate between rupee and dollar, and you can say 76 rupees is the price of the dollar. So now I am going to give you a class work. Before that, what is home currency? Home currency is also called domestic currency. Para 15. A country's own currency. A country's own currency is known as home currency or domestic currency. Your own currency, every country except maybe very few countries have their own currency. Currency is a symbol of the sovereignty of a country, that yes, this country is an independent country if you have your own currency. So different countries have different home currencies, they are known by different names. So dear student, just check your understanding, awareness about currencies of different countries. I will give you 10 seconds to complete this table. I will help you with the first one, India, Indian rupee. Okay, one more help, USA, US dollar. Try the other easy ones yourself. I have solved two difficult ones for you. No cheating allowed. Only based on your awareness, you just write down the name of home currency. Keep trying. Don't use Google. At least try now. Later on, you can do Google. You should know these currencies when you will travel abroad. You will require these currencies when you go to those countries. So time over. Now we'll check the answer and you give marks to yourself. How many you got it right? 1 mark for each right answer. -2 mark for each wrong answer. Then take the total, right? So answer is India, Indian rupee, INR, USA, US dollar, USD, UK, keep writing, Great Britain pound, GBP, Australia is called Australian dollar, AUD, Canada is called Canadian dollar, CAD, Hong Kong is called Hong Kong dollar, HKD, Japan, Japanese yen, JPY, South Africa is called Rand, RAND, but while writing they write ZAR. Switzerland, Swiss franc, but while writing we'll write CHF. So when you see in any question CHF, it is a Swiss franc, currency of Switzerland. UAE, United Arab Emirates, dirham, that is AED. So when you go to UAE, you will use that dirham. Then Saudi Arabia, Riyal, SAR, Saudi Arabia Riyal, SAR. Kuwait is dinar, Kuwaiti dinar, KWD. So this way, these are few examples. So today there is a homework for you. Say you will do it. Yes, we will do it. You will write the name of 10 more countries other than this and their currencies in the notebook. 10 more countries and their currencies. So try this practical homework. Any 10 country you choose and their currencies. And now we'll come to foreign currency. One more homework you do for understanding and enjoying this chapter. What is the exchange rate between Indian currency, rupee, and that currency? For example, what is today exchange rate between US dollar and Indian rupee, pound and Indian rupee, Japanese yen and Indian rupee, South African rand and Indian rupee? So at least try. You will get a lot of interesting insights, and you can find it easily on internet, the exchange rate. So one more homework, you write down the exchange rate today, the day when you are watching this video, between Indian rupee and these currencies. Only the first one, Indian rupee against Indian rupee, will be one only. Now I'll come to next paragraph number 16. What is a foreign currency? Foreign currency means any currency other than the home currency. What is foreign currency? It has to be understood in the light of what is home currency. For Indians, you fill in the blanks, that table. The foreign currency would be USD, Euro, GBP, Japanese yen, etc. But the moment suppose you are an American, Indian rupee becomes a foreign currency for you. So for USA, INR is a foreign currency. So these are relative terms. What is home currency will define what will be the foreign currency. For India, USD is foreign currency, but for USA, Indian rupee is foreign currency, and also Euro, JPY, yen, etc. So keep writing wherever you want to write. Next point. First, we'll just discuss with very basic thing. There are so many students who are not exposed to foreign exchange market. Directly starting a problem will be confusing. So we have understood home currency, foreign currency, exchange rate, how exchange rates are determined, and now one important term called spot exchange rate. Spot exchange rate means today's rate. Very simple. What is the exchange rate today? What is exchange rate today is called spot rate. Suppose you want to go to USA tomorrow, and you go to the bank and say, I want $2,000, please give me dollar. Bank will say today the rate is 76 rupees. 2000 into 76, you hand over that rupees and they will give you $2,000. Which rate did they apply? Spot rate. Today's rate. Spot rate is the exchange rate at which currencies are being traded for delivery on the same day. Contracts entered today. Shortcut. To buy or sell as on today. Contract entered today, and the exchange of two currencies will also take place today. So the rate at which this contract will be entered is called spot rate. Example is also printed. An Indian importer may need US dollar to pay for the shipment that has just arrived. So shipment has arrived. I have to make the payment. What will I do? I'll go to the bank and I will purchase the dollar at spot rate. The rate at which he buys the dollar in the market is called spot exchange rate. Now very quickly we will solve question number 1. One of the simplest question, not for exam but for just understanding. My idea is to start with the very basic knowledge of this chapter. The falling spot rates are observed in the foreign currency market. This is very simple. This is the currency in this column and the foreign currency per US dollar. Per US dollar means, in first example, 0.62 pound, this is the symbol of pound, is equal to $1. Is equal to $1. In second example, it means 1.90 Netherland guilder. So how do I write that? Netherland guilder, NG, equal to 1 US dollar. This is 6.40 kroner, Swedish kroner. So normally they write SKR, Swedish kroner, is equal to $1. This way you have to interpret 1.50 CHF per dollar equal to $1. 13,000 Italian lira per dollar means equal to $1, and 1.40 Japanese yen JPY is equal to $1. So these are the exchange rates for 1 US dollar. Question is not over. On the basis of this information, compute to the nearest second decimal the number of, now there are 6 questions. Calculate the number of British pound. The sentence will be calculate the number of British pound that can be acquired for $100. So this is a simple arithmetic question. How many British pound can be acquired for $100? And what is the exchange rate? The exchange rate is 0.62 British pound is equal to $1. So how will you solve? So I will teach you a trick. The problem says $1 is equal to 0.62 pound. I hope this is clear. If this is not clear, then we cannot proceed further. Foreign currency per US dollar. So 0.62 pound, this is pound, is equal to $1. And then you see what is given, British pound that can be acquired for $100. So suppose you are a US person who is going to UK with $100 in your pocket. So now you have landed at the Heathrow airport, big airport, and you have $100. You go to that exchange counter which is there, Thomas Cook, and you say, take this $100, give me pound. So how many pound will they give you against that $100? That is the question. And that's a very practical question, because when we travel in foreign country, we carry some currency and we want their currency. So what will happen now? One is simple common sense. $1 is 0.62 pound, $100 is 62 pound. Or otherwise use arithmetic, cross multiply. Cross multiply and you will get the answer. Okay, 100 into 0.62 divide by 1. So that is $62. So your calculation here will be like this, 100 into 0.62, and the answer will be 62 pound. Okay, now you try the next one. In calculation column, just write down 100 into 0.62, no need to write divide by 1, and the answer column 62 pound. Now the question will change and you have to think and answer. Every time don't multiply. So please understand B. We are on B. Dollar. Question you read like this. Calculate the number of dollar that 50 Dutch guilders will buy. Number of dollars that 50 Dutch guilder will buy. So once again, what is the equation? 1 US dollar is equal to 1.90 Netherland guilder or Dutch guilder. It is same. So this is Dutch guilder or Netherland guilder. Netherland guilder is called Dutch guilder, no problem. And now suppose you are a uh, Netherlands person, Dutch, they are called Dutch. So you are a Dutch. You go to USA. You have 50 Dutch guilder with you. You have just landed at that New York airport, okay? And you are walking to that exchange counter. How many dollar you can get from this 50 Dutch guilder? This is the relationship. So you, whenever you have to find this, what you have learnt in your school, cross multiply and divide by this. So my answer this time will be 50 divided by 1.90. So whatever answer you get, you write there 50 divided by 1.90, and they have said that you answer in 2 digits after decimal. So that is 26.32. And when you write the answer in this chapter, you write the currency in which this answer is presented. So 26.32 is what? 26.32 means it is dollar. Previously I had written pound because that question was different. Okay. So now dear student, please try yourself C, D, E, F for question 8 seconds. So either you will have to multiply or you will have to divide. So I'll give you some time, just apply arithmetic. In the question, $1 is equal to how many units of other currency is given. So if you have dollar with you, multiply. If you have other currency, you will divide. Just try little fast. Dear students, please try. Okay, we'll check the answer now. It was very easy. So you please check the answer now. On the screen the answer is there. Third question, Swedish kroner that can be acquired for $40. $1 is equal to 6.40 kroner. $40 will be 40 into 6.40. Check the answer, 256 kroner. 256 kroner, Swiss franc. The question says dollar that 200 Swiss franc can buy. $1 is equal to 1.50 Swiss franc. So 200 Swiss franc is equal to how many dollar? 200 divided by 1.50. $133.33. Question number 5. Italian lira that can be acquired for $10. $1 is 1300 lira. This is easy. $1 1300. $10 13,000 lira. And the last one, dollar that 1000 Japanese yen will buy. Just be alert. $1 is 140 yen. $1 is equal to 140 yen. So 1000 yen equal to how many dollar? 1000 by 140. $7.14. $7.14. Now this conversion exercise I have done because this is what this chapter is all about. You have to continuously do the conversion. Student is wondering, at some places we have multiplied, at some places we have divided. Why it is like that? It depends on rate is given for which currency. Like in this question, the rate is given for US dollar, rate per dollar. And then you have to see the transaction is happening in which currency. So in first example, the transaction is happening with $100. Rate is for dollar, currency given in question is $100, multiply. If the rate is for dollar and the currency given in question, the amount is given in dollar, multiply. But if you see the second, fourth and sixth problem, rate is for dollar, but the currency given is the other currency, which is 50 Dutch guilder, 200 Swiss franc or 1000 Japanese yen. In that case, divide. In that case, divide. Simple common sense exercise. If one apple is 25 rupees, I have 10 apples, what will I do? I'll multiply. So if the rate is for apple and I have given apple and they're asking you to find out rupees required, I'll multiply. But if one apple is 25 rupees and I have 500 rupees note, one apple is equal to 25. So rate is for apple. I have given 500 rupees. How many apples will I get? So I will take 500 rupees divide by 25, 20 apples. As simple as school level arithmetic. You have to manage it. Only then we can proceed ahead. Now we'll take a break.